Are we on the verge of a global liquidity crisis? The answer is yes and no. And I know what you're thinking. That sounds crazy. How can you make that claim? Well, in today's video, I'm going to prove it to you. I'm going to explain to you why the short term is looking dangerous for global liquidity, but if we can make it through the fog of war, the other side is looking very, very bullish. So, if you want to find out just what the heck is going on, throw me a like down below and let's dive in. So, why are we in a global liquidity crisis short term? Why does the global liquidity even matter? If you're in crypto, you've probably heard this M2 money supply, liquidity. It basically is the amount of money in financial markets, in the system. And the more money there is, the higher asset prices go. And that's really kind of what you need to know for this video to stay along with us. Now, I want to show you this, and this is an executive summary from Darius Dale over at 42 Macro. And if you're macro inclined like I am, this is a great source. So if you're not checking them out, check them out. These are the 6 key cycles that influence prices in and across asset markets, including crypto: growth, inflation, monetary and fiscal. This is central bank. This is government policy, liquidity, and positioning. So this right here, these 6 things is what affects prices in markets. So we're getting to the source here. Zoom in on liquidity. The good news is that PBOC, People's Bank of China, it's a Chinese central bank, failed attempts at reflation. They're trying to create inflation, create excess liquidity for global financial markets. 13% year-over-year growth rate. Okay, so that's good. We're seeing liquidity growing in China, and we're going to get onto that in a second, why that's important. However, if you zoom ahead, liquidity in the Eurozone, Japan, Switzerland, and UK is down 17, 8, 9, and 13%. So we're seeing a decrease in global liquidity from most of Europe and Japan, but we're seeing an increase in liquidity from China and the US, because currently China and the US are the only major liquidity supplying economies. And that's good, because China is the liquidity pillar of the East, and the US is the liquidity pillar of the West. So far, so good. We're looking good, but we're going to get onto this in a second why it's a problem. Recall that the US dollar, currency, and bond market volatility and energy are all counter-cyclical leading indicators. Basically, as these things go higher, liquidity goes down. I'm going to show you why in a second. And so basically what this means is that the longer the US-Israel Iran war persists, the greater the reduction in liquidity and decline in asset markets investors will experience. So let me show you what this means so that you can make this actionable. Okay, so let's hop across over to TradingView. First off, so we're 2 main things we're going to focus on. We're going to focus on the dollar, the DXY, and we're going to focus on what's called the MOVE index, or it's bond market volatility. I know it sounds kind of fancy, but it's really not that crazy. And I'm going to show you how we can plan for the future using this. So this is the US dollar here in green, and we have Bitcoin in orange. As the dollar becomes stronger or weaker, that influences liquidity because the dollar is the reserve currency. So when the dollar becomes stronger, all the other basket of currencies that are weighted against it, they become worth less, okay? So even though no money's coming out of circulation, global liquidity is falling. And you see that in Bitcoin's price. You see this right here. If you zoom in, we have the dollar going higher, we have Bitcoin coming down. And you can see that throughout history, we kind of have an inverse correlation. The dollar becomes weaker, other currencies gain value, global liquidity rises. Bitcoin is a fair indicator of the most liquidity sensitive asset, I would argue. And so Bitcoin goes higher. The US dollar goes higher, other currencies become worth less, global liquidity falls, and Bitcoin becomes worth less because it's tied to liquidity. So you have, as a result of this conflict, the US dollar increasing in value. And so you have liquidity falling. That's one scenario of why we find ourselves in this position. Let's move over to the MOVE index. Now, I know what you're thinking. This is fancy. I don't know what you're talking about. This sharp move here. Basically, what this is telling you is that people who buy and sell government debt, the US runs on debt, and they have to buy it and sell it to people. Most transactions are debt transactions. They're transacting in debt. When you have a global situation that's going on right now, like Iran and all the fighting and energy disruptions that we're seeing, you're going to see that market become sensitive. It's going to become jittery because it's a tense moment. So basically they're going to charge each other more for liquidity. They say, if you want me to borrow you money, I'm going to need more in return as interest. And so that's what this is telling you. This is telling you that the volatility in the treasury bond market, the buying and selling of government debt, is increasing. And that will drain liquidity because it makes people not want to do it. You know, if you're buying and selling Pokemon cards and something happens where all of a sudden, people are they want to ask for more money, or they're more hesitant to buy or sell cards, you're probably just not going to engage in that market very much. And that's exactly what's happening here. People aren't as engaged, and so the amount of liquidity falls. The amount of liquidity that's available to buy and sell debt with is going down. So that decreases global liquidity, okay? This is really what is causing the global liquidity crunch, but it hinges on the US-Iran-Israel war. So I want to show you a clip from Darius. It's going to help explain this, and then we're going to talk about, once this conflict is over, why I think that global liquidity is actually going to surge, and we should actually be in pretty good times.
But this is also an issue when you think about the net international investment surplus economies over in Asia that can't get the barrels of crude oil they need to grow their economies to generate the profits and the household savings that we need to continue to support in global capital markets. And so
So what the hell did he just say? Basically, what he's saying is that when he says net international investment surplus economies, he's basically talking about the economies that generate money, the economies that add liquidity, that are booming and that have investment and that can put money into markets, that can buy things like Bitcoin and Ethereum and whatever else, stocks and S&P. They aren't getting the oil that they need to fuel that economic activity. And so they don't have the money that they need. On the other hand, you have, as we mentioned, the US dollar rising, you have bond market volatility rising, which is draining liquidity. And it's all of this as a result of the Iran conflict. So that's the bad news. The good news is that once this is in the rearview mirror, we can start to look at really, I think, what is a more structurally bullish scenario for liquidity. And so I want to show you this chart. This is from Andrea Steno over at Steno Research. He's also over at Real Vision. Few things going on here. What you need to focus on is this right here, Fed net liquidity, the amount of liquidity that the Fed has on their balance sheet. That's going to be the US liquidity going higher. And it's projected to go higher because of a couple of things. This red line is a Treasury General account. This is how much money the US has in its piggy bank. When this goes lower, when the Treasury General account goes lower, liquidity goes higher because you're taking it out of the piggy bank and you're putting it into the economy. You're putting it into financial markets. That is good. This is what's called the reverse repo, and it's essentially another piggy bank. Just think of it as another piggy bank. It's basically empty. Up here, this was the bear market of 2022, 2023, when they took all the money away from financial markets and they put it into their piggy banks. They put it in their piggy banks here, and they put it into their piggy banks here. So they took it away from us, and they put it in their pocket. Now, they're taking it out of their pocket, and they're giving it back to us, which is nice. Don't worry about this. That's just macro jargon stuff, which isn't super important right now. What we need to understand is that this is trending higher because these are trending lower. And once you have this conflict settle down, you're going to see bond market volatility fall, more borrowing and lending in the bond market, more buying and selling of government debt. You're going to have the US dollar fall. So now all the other currencies that are weighted against it become worth more. Global liquidity is increasing. And I want to show you a clip from Andrea Steno where he goes over this and basically tells you that we are essentially just waiting for this conflict to end before we can see a solid uptick in liquidity. So check it out.
The way is actually paved for a big spike in risk taking if the fog dissipates, if you know what I mean. If there is a little bit more clarity around the direction, we'll see a lot of risk taking on the back of that.
And so he's telling you that we're primed for more risk taking because of this, because of this, because of this, and also because of this. We don't have to get into that right now. So we're looking good down the road. So yes, we are in a liquidity situation because of this conflict. It's affecting the things that I just talked about. But if we can get over that, if we can get past that, then we're looking pretty good from a liquidity standpoint. China is still printing a lot of money. They still have money coming into the system. The US is still looking good. If we can get the dollar lower, if we can get volatility lower, they can start easing. We have Kevin Morse coming in. He might be cutting rates. A lot of debt has to get refinanced this year. They have to print money to do that. So ultimately, that situation is not looking terrible. And I want to show you one more clip, and this is just kind of a broad take on how markets are, I think, likely to react if we start to get clarity on this Iran situation. If we can get clarity on the energy situation, which really is the problem here. Wars are not terribly unprofitable, as I'm sure we're all aware, but it's the uncertainty around energy that's a big problem for us. And so I want to show you this clip from Stephanie Link. She's the chief investment strategist over at Highwater. Check it out.
If we make any progress there in terms of opening it up, the market is going to rally pretty substantially, in my opinion. And that's one of the reasons why I want to be, kind of leaning into buying stocks on really ugly days.
So she's talking about progress in the Strait of Hormuz. Any progress? Looking good. And she says she's going to be buying stocks. Me, I'll be buying crypto. I don't know about you, because I'm still bullish on this industry. I'm still bullish on the future of blockchain. And I'm actually still bullish on 2026. But time is ticking. I will not lie to you. If we're in this situation for another 2, 3, 4 weeks, then it's starting to look a little bit, but we'll jump off that bridge when we come to it. And if it does come to that, you can be rest assured that I will tell you. I will give you the updates and I will keep you informed. And if you appreciate this video and you want to keep getting updates like these, you got to throw me a subscribe down below. I would really appreciate it. Also, leave me a comment. Let me know if you learned anything. Do you think that we are in a global liquidity crisis, or are we about to come out clean on the other side? In either case, thank you for being here. We'll see you in the next video.